This is on the back of consistent delivery of commitments that we made, and really has us puts together a strong foundation for growth that we will talk about as well. So standalone results first, revenue up 47%, profit for EI up 52%. There were some adjustments that were made in terms of extraordinary items, and that gets the overall profit to up 34% for the year. As you look at consolidated results for F23, revenue up 34%, profit before EI up 42%, and after EI up 56%. I'll request Rajesh and Manoj to go through the details, and then we'll come back talking about the foundation for growth and where we take it from here.
Good afternoon, everyone, and welcome to this meet. I'll start with covering the farm equipment and then move to auto. So you can see this is our growth in volume in Q4. Tractor volumes were at 89,000 numbers, growth of 24%, and we increased the quarter market share by 230 basis points, our highest Q4 market share in the last 12 years. For the full year, we did over 400,000 volumes, a growth of 15%, a market share of 41.2, which was up 1.2% over the last year and leading to a 3% improvement in market share over the last 2 years. This graph kind of plots our market share over a period of time. We've been using this graph often, but the numbers are same as what you saw. So F23 market share was up 1.2% to 41.2, and Q4 market share was the highest in 12 years at 40.7. We're launching, have introduced in 5 states already, new Swaraj, very new styling, appealing to the young and new customers, but it's not just styling. It is significant improvement in product as well. Enhanced power and reliability both, better ergonomics and comfort, an upgraded engine, and an improved lift capacity. You can see we brought in things like digital clusters and LED lamps as well. We're introducing a new Swaraj Lightweight Series platform that launches next Friday, 2nd June. This platform will have a 25 and a 29 horsepower product to be launched in phases. This is a segment, new segment for Swaraj in a way. It will be a specialist spraying and interculture application product that will be launched next Friday on 2nd June. The Mahindra Oja, which we had code-named K2, will have its global launch on 15th August. This will be a launch, of course, for the Indian market, but also a launch with a global mindset, and hence it's being called a global launch. We believe it's the most technologically advanced global tractor platform. We've created 4 new platforms, as you know, which is going to be branded Mahindra Oja. The farm machinery business is a business for growth, and we'll talk about it a little more over the next closing of this presentation. We saw very robust growth in F24, and we expect to see this business go up multiple times. It's a huge growth opportunity for us. We've improved our rotavator market share. We're now number 2 in rotavators with a new portfolio offering. A quick look at the Q4 farm financials. A strong growth in revenue and a very strong growth in PBTI as well, and likewise on the consolidated side, you can see that our revenue and our profits were both up quite significantly. For F23, again for the farm business, the revenue is up quite significantly on the standalone and consolidated basis, consolidated at 32,000 crores, and the profit is up as well in consolidated to 4,200 crores. This is a data we are sharing for the first time. What you see in the bar graph on the right is our separated out tractor margins. What you see on the left is something that you've seen often, which is our total farm equipment segment PBIT. So when you look at our tractor core PBIT, this is domestic plus exports from India. The quarter four margins actually have seen a very, very healthy improvement. It's at 18.3%. And we've just given as a reference the F19 margin, which was at 19.9 in the core tractor segment. So 18.3 is now moving directionally, coming closer to the F19 margin. This is, as you know, in spite of us having taken, gone through a very huge commodity inflation over the last 2.5, 3 years. And even though we've now passed on all the material costs, just the denominator effect on margin is much higher than this, which means we brought in efficiencies to make the 18.3% margin directionally close to F19 in the core tractor business. Lot of talk around El Nino, so we thought we'll put this slide out. Of course, today we've seen the IMDS put out a report saying monsoon is expected to be normal, but I think this is a useful data to put out for all of you to understand. This is a data over last 50 years. So in the last 50 years, there was El Nino in 17 years. This is the 17 years in which El Nino took place. What you see in the first column is which were the years in which there was deficit rainfall during El Nino. What you see on the right is what happened to the tractor industry in that year. So out of the 50 years, there was El Nino in 17. Out of the 17 years, there was deficit rainfall in 5. And in only 2 of those years, there was a negative tractor industry growth. So really, this whole thing about El Nino leading to an impact on tractor market is really not data-based at all. Moving on to the automotive business. Volumes in quarter 4 were up 21%. SUV revenue market share was at 19.6%, which is an improvement of 1.7 points. And again, we were number 1 in revenue market share over the last 5 quarters. In F23 for the full year, our volumes were up 50%. We got to 698,000. Our SUV revenue market share for the full year went up by 3.7 percentage points. This curve shows you the increase in our SUV volumes. As you can see, in the last quarter, we did 99,000 plus, which is an average of 33,000 per month, and a significant improvement over quarters. And as I mentioned earlier, we were number 1 on revenue market share for 5 consecutive quarters. This is the data we've been sharing in every quarterly meet. The open bookings has gone up from last quarter. Now it stands at 292,000. We still are getting 55,000, 57,000 fresh bookings per month. We've been billing 33,000 per month, as I just said. Cancellations is less than 8%. Some of our new launches have added to the open bookings because, Thar, rear wheel drive and so on have all got very, very good response. And you can see that hence the open bookings has gone up to 292,000. We've revealed, some of you were there in Hyderabad, the whole Born Electric portfolio that's got very good feedback as more people have seen it in person. These will be launched from early part of 2025 as per schedule that we put out. The programs are on schedule. These events had a reach of 65 million with views of 25 million and 2.7 million plus engagements. Moving on to LCV less than 3.5 ton, where we are a strong player, very big uptick, a strong uptick in volume. In the course of F23, we've gained 5.2 share points, which for a market leader is a very big gain in market share. We've recently launched the all-new Bolero Max pickup range, which has got very, very good feedback. We've introduced a 2-ton payload, which is a category-creating product for the first time. and many first-time segment features, including a telematics technology called IMAX, 10 feet cargo box and so on. Initial feedback and response from the market is extremely strong. The last mile mobility business seen very strong growth. As you can see in the Q4, the blue bar, which represents electric, is now a very large part of the quarter volumes. We've seen the highest ever volumes in electric volumes in Q4 of 14,700, and we continue our strong market leadership. We've, as you know, announced that this business will spin off into a separate company called Mahindra Last Mile Mobility, which has been valued at around 6,000 crores, with IFC bringing in a 600 crore investment in the business. We are expanding our Zahirabad facility and setting up a state-of-the-line battery assembly there. We've also set up a new trio line in Haridwar. Quick look at the auto financials. The very strong growth in revenue, very strong growth in PBIT, both at a standalone and a consolidated level. And likewise, a very strong growth in revenue and PBIT at both standalone and consolidated level. And we've seen Q4 profits at over 3,600 crores for the auto business in the year. This is a journey of our margin improvement. Again, here we've put out the auto margin in F19. F19 was one of our best years, and that's why we are taking F19 as a non-COVID impacted strong year comparison. We were at 7.8% PBIT margin then, and we are now in Q4 at 7.3%. Significant margin improvement over the quarters and coming back very close to the F19 level in spite of a very significant commodity inflation that we all know we have seen over the last 2.5 years. So a very strong trajectory on margin improvement. Manoj will talk a little about the mix impact between auto and FES on the weighted margin as he presents. But as you can see, both FES and auto have improved the margins very strongly. I'm just going to take a couple of slides on the 3-year journey. This is the F22, F23. We can see 21,000 going to 32,000 crores revenue, PBIT of 2,000 plus crores going to 4,200 crores, and a very strong improvement in ROCE for the FES business going up to 61.6%. On the auto side, close to 60,000 crores revenue, 3,600 crores PBIT, and a very strong ROCE now of 30.9% in the auto business, which in F20 was, as you can see, close to 11%. I'm just going to cover a slide we had presented in May 21 and give you all an update on where we are on commitments that we had made in May 21 for the period 2025. So we'd said the revenue growth would be 15 to 20% CAGR and multiple other things. So here's the update. The revenue growth has been upward of 35%. We had said we'll have leadership in the SUV segment, and we've covered that already. We've been number 1 for the last 5 quarters. We had said we'll continue our leadership in the LCV less than 3.5 ton segment. I spoke about that. Very strong market share gain, a very strong market share gain in tractors, quantum growth in farm machinery. We're looking for much stronger growth, but already we've seen a very strong growth. In brand power study, which is an internal tracking we do through an external market research agency, we continue to be number 1 in the brand power in the SUV segment. We had said we'll reduce 3% cost as a percentage of revenue. That's already happened. And we've said we'll deliver an ROC of 18% plus, and you've seen it, a very strong ROC for F23 that was over 40%. So this is just to kind of say that when we make commitments, we make sure we deliver them. And these are the commitments we had made in May 21. Now, 2 years later, we are on a very good path to achieve the commitments that we had made 2 years back. What next? Just a quick, and Anish is going to spend more time on, talking about the future as a strategy. But just the key strategic imperatives on the farm equipment side, we will build a strong domestic fortress, continue to grow market share through product launches, there's some in the pipeline already, and channel expansion. We'll look at scaling farm machinery exponentially, 10 times where we are by F26. Significantly grow our international business by 1.6 times by F26. Pioneer significant new technologies which we think will drive transformation, many of them through IoT devices, electrification and automation, and leverage partnerships both for farm machinery and global growth and for technology solutions. On the auto side, propel ICE SUVs with cutting edge products and maintain our number one in revenue market share position. We are pioneering a new era with category creating electric SUVs. The feedback that we get as we show it to consumers, dealers, and many of you are that the kind of designs we have and the offering that we have by way of the tech pack is really going to create a category of people for whom these products will be very desirable and aspirational. And that will be the driver of the category creation. Build a strong commercial vehicle moat and maintain strong leadership. We have a very, very strong offering with our Max Pickup portfolio. Go global. We are planning to scale up international operations 2.5 times from where we were by F26 and be very customer and have very customer obsessed brands. Maintain our brand power through a very differentiated brand experience and innovative omni-channel models. With that, Manoj.
Thank you, Rajesh. And a very good afternoon to everyone. I'm going to run through some of the numbers. So if you look at the standalone results, a growth of about 31%. It was led by auto. Auto grew about 35% in the same period. And farm grew about 29%. If you look at the PAT before EI, a growth of 67%. In this one, what has happened is the auto profitability has increased. So if you look at a year-on-year or for same quarter last year to this year, 108% growth in auto and about 39% growth in farm on a standalone basis in terms of PAT before EI. And there are some EI elements which we took during the course of the year because of certain actions on capital allocation. So if you look at the impact for this quarter, I think it's about roughly about 430 crores of negative impact because of EI. Post that, there's still a growth of 22% in PAT before EI. If you move to the next slide on the consolidated level, I think again auto leads the way, 34% growth. Farm is about 30% growth. 2 or 3 highlights from the group companies. I think there's very good growth shown by real estate. Hospitality showed a smart uptick in revenue growth. If I look at PAT, again, auto was about 137% PAT before EI growth, and farm was about 26%. And in terms of EI at the consolidated level, there is a small positive impact during the quarter of about 37 crores because of some of the actions we took. If I look at the full year numbers, auto grew about 63% at a standalone level and farm grew about 22%. So this kind of corroborates what Rajesh was talking about. I think it's been a strong year for both auto and farm. In terms of profitability, I think auto grew about 185% during the course of the year and farm grew about 15%. And during the course of the year, we had a net negative impact of about 1,200 crores because of EI, because of the various actions we took. And if I look at the consolidated, very strong performance, 121,000 plus crores of revenue, revenue growth of 34%, led by auto and farm, but also I must highlight real estate and holidays. If I look at PAT before EI, auto more than doubled profits during the course of the full year. So very strong performance. And EI is positive to the tune of about 1,400-1,500 crores for the full year. Talking about some of the subsidiaries, first is TechM, a very healthy revenue growth of 19%. However, if you see the PAT was a negative 13%. I think the year was marked by very strong deal wins, total contract value of 2.9 billion, which was one. But obviously the market demand has been softening towards the end of the year. And margins have come under pressure, and that's an improvement area for the future. If I look at Mahindra Finance, the journey continues. Disbursement growth of 80% during the year, almost 50,000 crores disbursed. And the combination of this growth as well as the focus on collections and NPAs, I think doubled profits to about 1984 crores. So very strong performance there. If I look at the other growth gems in terms of logistics, I think the revenue growth was about 24%, and the revenue crossed about 5,000 crores during the year. So a good demand environment, and profits doubled, profits grew by about 50%. Now this is absorbing the losses of Rivigo, which was one of the loss-making subsidiaries, which was one of the acquisitions which we did during the year, which have impacted the number in the second half of the year. Hospitality showed a strong rebound. I think as post-COVID, I think we are seeing very high occupancy level of 84% in India. Even the European business, which is HCRO, I think we saw that towards the end of the year, we saw a revival coming through. So a 71% growth in profits in hospitality. And finally, real estate, now the 155 crore number which you see in F22, that has a one-time element. But if you look at the underlying business momentum, it was a record year from a residential sales perspective, north of 1,800 crores of residential sales. The company also forayed into redevelopment, and 2 new deals were won. And then the IC business continues to be strong, both Jaipur and Chennai. So very well poised for growth. Just a recap of how the numbers add up from last year to this year. So last year we had a total of about 6,577. Auto and Farm contributed 2,332 crores. TechM and MMFSL, the 2 big other companies which we classify as core, contributed about 286. All of it came from MMFSL. If you look at the growth gems, 64 crore positive, and then EI, we showed it separately, about 1,000 crores of EI. That's a build up to the 10,282. Just a quick look at cash flows for the year. I think we started the year with about 12,100 of cash balance. It's been a very, very strong year of cash generation. Total inflows from group companies as well as Auto and Farm was about 12,677 crores, which is very, very strong. And we invested in capex about 3,500 crores during the course of the year. In addition, both for Auto and Farm and for group companies, we deployed about 3,100 crores. Now this highlights where we did invest in Swaraj to make it a subsidiary, as well as we did invest in Mahindra Electric during the course of the year. Those are 2 numbers which I would like to highlight in this 3,100 crores. And then we go on a journey of deleveraging the balance sheet. And from that perspective, we repaid down almost 2,350 crores of loans during the year and paid out a dividend of 1,400. So we are in a very strong cash position with about 14,400 crores in cash as of March end. And in terms of deployment, I think we had shown you a number almost more than 3 quarters back, that we would spend a net amount of 15,075 crores over the period F22 to 24. As we have gone through a combination of strong demand as well as what we are seeing in terms of the demand outlook going forward, I think we are upping the forecast in terms of capex for the same period. In terms of auto ICE, we are upping it by about 1,600 crores. In terms of EV, I think we are upping it by 1125 crores. And auto and farm investments, this is largely increasing because of some of the actions we did in some of the companies. But what is coming down is because of the external funding, we think that we don't need to invest so much in the other group companies. And we also think that the journey on monetization and partnerships has gone much better and much faster. So that is a number which we see more benefits coming through. So overall, if I see at a net level, the same period, the number which was 15,075 is now 15,900. So that's the outlook which takes care of whatever has happened in F22, F23, and we are also considering what will happen in F24. With that, I hand it to Anish for his section on the way we look at the future and the strategy. Anish, over to you.
Thanks, Manoj. So, you heard us say before that M&M was the best performing stock in the Nifty since 2002. And earlier we had said it was the best performing stock from 2002 till August 2018. Well, now we are back to being the best performing stock. And for the last 20 years, as we look at the basket of stocks that were there in the Nifty in 2002 and their performance over 20 years, M&M is once again number one. Driven in a big way by performance over the last year. Let's look at the history of value creation. From 2002 till 14, we grew at 43% CAGR in terms of profits. And then had a period where it was flat to negative, in fact, negative 5%. And then over the last 2 years, we've seen a 75% CAGR in profit after tax. So in each of the last 2 years, on average, we've grown 75%. This was driven by very sharp strategy around capital allocation to start with, and then a pivot to growth. We established growth gems and really drove transformation in our businesses. We committed to 18% ROE and a 15 to 20% EPS growth. What you see here is a list of companies that we had talked about, and you may recall category A, B, and C that we had mentioned at one point. The category A and B companies have largely turned around, with the exception of 2 which are still in process. The category C companies we've exited. And you see a large list out there, and that is all complete now. And therefore you see the losses that we had from this group of companies of 3,429 crores is now on. It's almost break even. And with the turnaround being completed for some of the others, we will be in positive category very soon. What's driven this? This is driven by transforming the core in terms of our profit uptick over the last 2 years. The auto business has seen 5 mega launches. EV has been a great story, both from a 4-wheeler and a 3-wheeler standpoint. And we see the UV market share or the SUV market share go up from the 13% range to 19.6%. A very significant uptick there. You see the same uptick on the farm side, where the numbers may not be as high, but going from a 39% to a 40.7% share is very significant. Mahindra Finance has gone through a huge turnaround, and we're, I would say, more than halfway through it right now, so not complete as yet. But there we've seen significant growth in disbursements and assets, and more importantly, much better and much stronger asset quality. The GNPAs have come down from 8 to 9% range to 4.5% right now, and net NPA is 2.5%. We've seen a very strong turnaround in Mahindra Finance, and TechM, it's underway at this point. Margin transformation will commence, but there's a huge opportunity in TechM to transform its business as well. And beyond transforming the core, we established our growth gems. I'm not going to go through the entire list here, but what you can see on the right-hand side is the valuation increase we've seen in these growth gems in the last 2 years. That has been very significant in many cases. If you look at last mile mobility, it's gone from less than 100 million to 730 million in just the last 2 years. So we've delivered and built a strong foundation for growth. Return on equity is 19.9%, well ahead of the 18% we promised and well ahead of time in terms of what we promised as well. EPS growth has been significant, and that is something that's reflected in market cap. But more importantly are the enablers that you see at the bottom of the page. Purpose, talent, data and technology, customer experience, and synergy. These are the enablers that are driving our growth, and these are the enablers that give us a very strong foundation for the future. So as we think about the future, what is our opportunity? India is very well positioned across global macro trends. And we'll cover a little bit of it. We can cover more in questions as needed. More importantly, today India is ready to deliver, and businesses in India are ready to make world-class products take across the world at scale. And Mahindra is very well positioned in all the industries that are going to be significant in India. This is a very busy chart, and we've uploaded it, so I will leave it to you to read at leisure. Basic messages I would highlight here is, as you look at the global macro trends around consumer attitudes, digital economy, geopolitics, and the other trends that we have here, in each of these, India has a significant advantage. India will add 4.2 trillion to its GDP by 2030. This is from a number of different global estimates. And here are the sectors where it's going to come from. So here again, I won't go through the slide in detail. We have it up on the website, but what you will see here is, across all of these sectors, how is Mahindra placed? We've got significant businesses in all the key sectors where India is poised to grow. Except for infrastructure, which is one area where we decided not to play in. And herein lies our opportunity. So as we look ahead, our focus is on delivering scale, on market leadership, on resilience, on value creation. And here's how we will deliver scale. First, capitalize on market leadership. We're number one in SUVs, number one in tractors, number one in LCVs, number one in electric three-wheelers. And we have been growing share in all of these areas. Unlocking full potential for Mahindra Finance and TechM. And we now have a new challenge for our growth gems. You may recall that we set up our growth gems as companies which have a potential and a plan to reach $1 billion of market cap in 3 to 5 years. Now that alone is not enough. What we have is a challenge of 5x. So each of our growth gems have to grow 5x in the next 5 to 7 years to remain a growth gem. Rajesh covered auto and farm in a fair amount of detail in terms of how we capitalize on market leadership. So I'm not going to go through this page. We can again cover that in questions. Unlocking full potential. Mahindra Finance is about very strong asset quality, driving digital transformation, growth through diversifying its businesses, which will also help asset quality, and high impact partnerships around the ecosystem. TechM is about margin expansion. Leading in technology, new age offerings, deep tech, and synergies with portfolio companies, which we've started tapping, but we still have a long way to go. And the 5x challenge for Growth Gems will take each of these businesses to a very different scale. Each of the businesses today are very well positioned in the markets they are in. They've got a great set of offerings, a great set of customers as well. And it's for us to scale it now. So in summary, we've been talking about reigniting value creation in the past. I would say that we have reignited it already. We're very well positioned to tap into opportunities across India, to deliver scale, transformation of our core, and a 5x growth across our Growth Gems. And we have today leadership in sustainability across the world, and that leadership is something that we will maintain. With that, thank you, and we will open it up for questions.
If you can raise your hand, state your name and the media house you represent, please.
Hello, I am Pratik Rakshit from Acco Drive. My question is related to the booking, the waiting period for your XUV 400, Thar, and how long do you think it's going to take to, reduce the waiting period?
Pratik, just didn't hear the question fully. Waiting period for
The XUV 400,
Yeah.
XUV 700, and as well as the Thar.
Yeah. So we had put out a capacity expansion plan, and we had said that by March of this year, that's 2 months back, we would be at a 39,000 capacity for SUVs. That's been done. The gap that we are seeing right now between the actual volume, which is 34,000 and 39,000, is not the capacity, but specific semiconductor shortages which may be impacting the ability to get to 39. So when we talk about capacity expansion, it's the readiness of capacity. There will be short-term issues around some semiconductor not being available, which may impact us. Like we've shared in the past, we are having some issues on semiconductors which are impacting Scorpio N and XUV 700 ramp up specifically. The next wave is going to be of capacity increase will be 6 months, 7 months later, which is when we will go from 39 to 49,000, which is when the XUV 700 Scorpio N will all move to about from their current capacity of 6,000 to about 10,000. So it's after that we expect to see waiting period coming down. Couple of points out of my slide, just want to highlight. The number of new bookings, just to take XUV 700 as an example, is almost 8,000 every month. Our current capacity is 6 and we are producing a little lesser than that. So the rate of new bookings, in spite of the open booking period, is higher than what we're producing. As we've said in the past, it's not a situation we're happy with because at the end of the day, today customers don't want to wait that long. We are not at all thinking that this is a good thing to continue. Hopefully over the next 6 months, we'll start seeing, the number of open bookings come down. You may at that time think that's negative, but we would see that as a positive number to put out to say number of open bookings are coming down as our production is ramping up further. As you saw on the chart, we have seen a significant ramp up in our numbers, and which is, we do talk about being number 1 by way of revenue market share, but we are number 2 brand by way of even volume market share in spite of the portfolio which is skewed to bigger or higher priced products. So, it's a very good accomplishment for a brand operating at our kind of price points. So we would start seeing that happen as a SUV portfolio specifically over the next 5 to 6 months. Thank you, Pratik.
Hi.